Welcome back to Talk Tickers. It is Sunday, February 15th, 2026. If you are tuning in right now, you are looking for the signal, not the noise.
That's the mission.
And today we are looking at a signal that was flashing neon bright on Friday. We are breaking down the Q4 and full year 2025 results for Enbridge, ticker symbol ENB.
It's good to be back. And you're right, Friday was a little weird. In a good way, I mean, but weird.
Weird how?
Usually, utility and midstream earnings are sleepy affairs. You check the dividend yield, you check the coverage ratio to make sure they can actually pay it. You might glance at the debt, and you move on.
Right. It's a box-checking exercise.
Exactly. But Friday felt different. There was a buzz.
It felt very different. Let's set the scene a bit for everyone listening. The results dropped pre-market on Friday the 13th, which... That was an ominous date, but this was certainly not an ominous result.
Not at all.
The stock opened up a little, maybe around 52.50. Nice little pop. Standard stuff. But then something happened during the trading day. It wasn't a sell the news event. It was a buy the narrative event. By the time the closing bell rang, we were at $53.88.
Which is a huge move for them.
It is. That is up $2.01, or nearly 4% on the day.
For a stock that typically moves like a glacier, I mean, steady, slow, massive. A 4% move in a day is a sprint.
It's a full-on sprint.
A move like that on an earnings print for a company with a beta this low is really significant. But what really caught my eye, and I know you saw this too, was the volume.
The volume was absolutely wild. I mean, we were talking about a massive spike.
It's just enormous.
Over 20 million shares traded. The average is what, closer to 4.5 million?
Around there, yeah. So this is nearly 5 times the normal activity. This wasn't just, retail investors buying a few shares for the dividend.
Yeah.
This was institutional accumulation. Big money was moving in.
And it wasn't just the equity volume, was it? The options market also went a little crazy.
Oh, it lit up like a Christmas tree. We saw unusually heavy call activity. I think it was over 81,000 contracts traded.
What's typical?
Maybe 2,000.
Yeah.
A busy day. So when you see that kind of leverage, that kind of bullish bet being deployed on a utility-like stock, it tells you something.
It tells you the market isn't just buying the last quarter's numbers.
Exactly. They are positioning for a forward-looking shift. The vibe was bullish because the tape was bullish. Simple as that.
So the market bought the narrative. But before we get into that narrative, which, spoiler alert, involves a massive pivot to AI and power infrastructure, we have to eat our vegetables.
We do. We have to look at the numbers.
You can have the best story in the world, but if the cash flow isn't there to back it up, the story falls apart. And they delivered a beat, a pretty solid one at that.
They did. This was a classic beat and raise style quarter, or at least a beat and reaffirm with swagger. Let's just run through the headline numbers. Adjusted earnings per share came in at 88 cents Canadian.
And the consensus on the street was what, 77 cents?
COD $1.77. So an 11-cent beat. That is a 14% beat.
Okay, let's pause on that. In the world of boring pipelines, a double-digit earnings beat is rare, isn't it?
It's very rare. I mean, usually these analysts have the models dialed into the penny because the contracts are long-term and they're fixed. A 14% variance implies something is running much hotter than expected.
Right. It's not an accounting rounding error.
No, and GAAP EPS was right there too at $C.89, so this wasn't some kind of accounting gimmickry or, one-time tax credits fluffing the numbers.
Okay, what about the top line? Revenue.
Revenue was $12.32 billion, up over 6% year over year. But for the yield-focused investors listening, and I know that's a lot of you, because let's face it, you own Enbridge for the income.
For the dividend check.
For the dividend check.
Yeah.
The number that really matters is the cash flow, specifically distributable cash flow, or DCF.
Let's just quickly define that. Why do we ignore net income and focus on DCF for a company like this? It's a question we get a lot.
It's a great question. So pipelines are asset heavy. You spend billions of dollars burying steel in the ground.
Right.
And according to accounting rules, GAAP, you have to depreciate that asset every year. That depreciation gets counted as an expense and it lowers your net income. But it's a non-cash expense. You aren't actually writing a check to anyone for depreciation.
It's an accounting fiction in a way.
It is. So net income artificially looks lower than the actual cash that's hitting the bank account. DCF adds that depreciation back in, and then it subtracts only the maintenance capital needed to keep the pipes running smoothly.
So it's the real cash, the cash available to pay us, the shareholders.
It represents the actual cash available to pay dividends, yes.
Perfect. So with that lens, how did the cash look?
Enbridge is a cash flow machine. Q4 DCF per share was $47. For the full year of 2025, they generated $5.71 per share in distributable cash.
Wow.
To put that in a bigger perspective, for the full year, they generated nearly $20 billion in adjusted EBITDA. They basically hit that $20 billion mark right on the nose.
That is just a staggering amount of cash. And it really speaks to the consistency of the business, doesn't it? Management made a real point to highlight this streak they're on.
20 years. This is the 20th consecutive year that Enbridge has met or exceeded its financial guidance.
Just think about that for a second.
I mean, think about what has happened in the last 20 years. The 2008 financial crisis, the oil price crash of 2014, the pandemic in 2020, the inflation spike of 2022.
Right. Wars, plagues, crashes.
And through all of that, they have hit their numbers for 2 decades straight. That level of predictability is what commands a premium. It's the sleep well at night factor.
And speaking of sleeping well, they gave the shareholders a raise again.
They did. They raised the quarterly dividend by 3% up to 97 cents per share.
That's the 31st consecutive year of dividend increases.
It is. So if you're keeping score, that puts the annualized payout at $3.88.
Okay, I have to play devil's advocate here for a moment. A 3% raise is nice, but it's barely keeping up with inflation. It's not exactly the double-digit growth we see in tech.
No, it's not.
Is a 3% hike really something to celebrate? Or is it just the bare minimum they have to do to keep their dividend aristocrat status?
That's a fair critique. It is slower growth than in the past. I mean, 5 or 10 years ago, they were raising it by 10%.
Right.
But you have to look at the total return proposition. You're starting with a yield of what, roughly 6.5% to 7%?
In that range.
So if you add 3% growth on top of that, you're looking at a roughly 10% total return annually, assuming the stock price doesn't move.
Okay.
In a world where risk-free rates are, sort of stabilizing or maybe even falling, a predictable 10% return is very, very attractive to pension funds and insurance companies. They aren't trying to shoot the moon. They are trying to compound.
That's a fair point. It's about the base yield plus the growth.
Exactly.
Okay, so we have a beat on earnings, massive cash flow, a dividend hike, and then they looked ahead to this year, to 2026. What's the guidance looking like?
It's intact. They reaffirmed everything. Adjusted EBITDA for 2026 is targeted between $20.2 billion and $20.8 billion.
And the DCF per share?
Between $5.70 and $6.10.
So no surprises.
And in this sector, no surprises is good news. It really is.
It means the guidance is de-risked.
It's de-risked. It's boring in the best possible way. It tells the market, we know what we're doing, the cash is safe, and the growth is locked in.
Okay, so that's the vegetables, that's the financial foundation. But as we said right at the top, that is not why the stock ripped 4% on 20 million shares of volume.
No.
The market didn't wake up Friday morning and get wildly excited about a 3% dividend hike.
Yeah.
They got excited about something else.
Absolutely. This is where the story gets really interesting.
Let's unpack the real narrative of this call, because this wasn't just a pipeline earnings call. This was an AI infrastructure call.
That is the pivot. We have seen this theme bubbling up in the utility sector for the last year or so. Companies like Vistra or Constellation Energy pop in on nuclear news. But Enbridge really planted a flag on Friday. They are positioning themselves as the picks and shovels of the AI revolution.
We hear picks and shovels a lot. Usually people mean NVIDIA chips or cooling systems or supermicro servers.
Are the direct inputs.
But Enbridge is making the argument that the ultimate bottleneck, the real choke point, is power. And you can't have power without the infrastructure to move the fuel to generate that power.
Precisely. The dominant theme of the Q&A session and the management presentation was data centers. It came up again and again, and they dropped a stat that I think caught a lot of analysts off guard.
What was it?
Enbridge is currently advancing over 50 distinct data center opportunities.
50. 50. That's not a pilot program.
Yeah.
That's a pipeline, no pun intended. And the scale of these isn't small, right? These aren't just little server closets.
No, these are massive hyperscale data centers. They estimated that these opportunities could require up to 10 billion cubic feet per day of new natural gas takeaway capacity.
Hold on. 10 BCF per day. I want to put that in context for everyone, because BCF is one of those industry terms that glazes people's eyes over.
It is.
What does 10 billion cubic feet of gas per day actually look like in the real world? How big is that?
It is enormous. I mean, to give you a rough benchmark, The entire production of the Marcellus Shale, the biggest gas field in North America, is maybe 30-something BCF a day. So this is like adding a third of a Marcellus.
Wow.
Or think of it this way. 1 BCF a day can power roughly 5 million homes. So we are talking about enough new gas demand to power 50 million homes.
From data centers.
From data centers, it implies a step change in demand for natural gas generation.
So the thesis here is the hyperscalers, the Googles, the Metas, the Amazons, they're building these massive AI data centers. These centers need gigawatts of power.
Unbelievable amounts of power.
And the grid is shaky. Renewables are intermittent. The sun doesn't shine at night. The wind doesn't blow all the time. But AI training runs 230/47.
It has to.
They need baseload power. And the only way to get that kind of reliable power fast is natural gas. And Enbridge owns the pipes.
That's the logic. And management had a great line about this. There has been this tension for years between, green electrons from solar and wind and brown electrons from gas and coal.
Right, the corporate ESG pressure.
Exactly. Tech companies want to be net zero. They have these aggressive 2030 climate goals. But the CEO, Greg Ebel, he basically said, customers don't care about the color of the electron anymore. They just need the electron.
That is a powerful shift in the narrative.
It's huge.
It's reliability over ideology. When your server farm is burning through power training, a model that costs $1 billion to develop, and if the power cuts for a millisecond, you lose the entire training run. You don't care if it's solar or gas, you just need the lights to stay on.
Exactly. I mean, ideally, they want it to be green, but practically, they need power. And Enbridge is uniquely positioned because they can do both. They aren't just selling gas transmission, they are effectively selling energy density and reliability.
And they aren't ignoring the green side either. I was surprised to see how specific they got with their renewable projects.
Yes.
Usually, big oil and gas companies just wave their hands at renewables in a vague, sort of corporate speak way. But Enbridge announced specific projects that directly tie them to the Mag 7 tech giants.
This was the other catalyst. They aren't just talking about it, they are signing contracts. They highlighted 2 specific renewable projects. First, the Cowboy Solar Phase 1 project in Wyoming.
Wyoming. Cowboy Solar. I love the name. It fits the landscape.
It fits. And it's a massive project. 365 megawatts of solar, plus another 135 megawatts of battery storage.
That's a US $1.2 billion investment.
It is. But here is the kicker. The output is fully secured by a Mag 7 technology company. They didn't name them, NDAs and all that, but they specifically said Mag 7.
And the battery system is being supplied and operated by Tesla.
Right, so you have a direct link to the biggest tech players in the world. Then you have the Easter Wind project in Texas.
Okay.
That's 152 megawatts, a $400 million investment. And for that one, they explicitly named Meta Facebook as the customer.
So let's look at the strategy here because this is key. Enbridge isn't building these massive projects on spec, just hoping someone will come along and buy the power.
No, never. That's the Enbridge way. They are famously risk-averse. They are locking in 15 to 20-year contracts with these investment-grade counterparties, companies with more cash than most countries, before they even dig a hole in the ground.
It completely de-risks the energy transition narrative. Everyone is worried that oil and gas companies will get left behind as stranded assets.
Right.
Enbridge is saying, no, we are building the infrastructure that big tech needs to survive and grow.
It is a brilliant pivot, and it changes the valuation conversation. If you are just a boring pipeline company, you trade at 1 multiple. If you are a critical infrastructure partner for AI growth, maybe you deserve a higher multiple.
And that's what the market was sniffing out on Friday.
I think so. It effectively rebrands Enbridge from an old economy stock to a new economy enabler.
It's fascinating. It's almost like they're becoming a utility for the internet itself.
Yeah.
But let's go back to the bread and butter. The liquid pipelines. The main line. This has been the cash cow for decades.
The absolute core of the business.
And recently there's been a lot of noise, a lot of debate about the main line.
There has. The main line is the artery of Canada. It moves crude from Alberta all the way to the U.S. Midwest and down to the Gulf Coast. For a long time, the fear was that with the Trans Mountain Expansion TMX coming online, the main line would lose volume.
Right, because TMX gives producers another option to go west to Asia.
Exactly. The logic was, if I can sell my oil to China for a better price, why would I send it down to a refinery in Illinois? So TMX opens, barrels flow west, and Enbridge's pipes run empty. That was the bear case.
That was the big bear case. But looking at the results, That didn't happen.
It didn't happen at all. In fact, management highlighted that the main line was apportioned for all but 3 months of the last year.
Okay, let's define apportionment for listeners who might not be deep in the midstream jargon.
Yeah.
It sounds technical, but it's actually a very simple concept.
It's super simple. Think of it like a traffic jam or a sold-out flight. Apportionment basically means the pipeline is overbooked.
Full.
It's full. The shippers, the oil companies, want to move more barrels than the pipeline can physically handle. If the pipe can move 3 million barrels a day, but shippers nominate, say, 3.5 million, Enbridge has to say, sorry, we have to cut everyone back by a percentage.
So that cutback is apportionment. It's proof that the pipe is running at max capacity.
It's the best signal you can get that the asset is in high demand. And they noted double-digit apportionment in January and February of this year, 2026.
So even with TMX taking barrels to the West Coast, the main line to the south is still stuffed to the gills.
Correct. Which implies that demand for Canadian heavy crude is outstripping the supply capacity of the entire egress network.
That is a very bullish signal for Canadian oil production. It means the oil sands aren't dying, they are thriving.
It suggests that production in the oil sands is growing faster than people expected, or that the demand pull from U.S. refineries is stronger than expected, or, probably both.
Right.
The U.S. refineries in the Midwest and Gulf Coast rely on this heavy oil. They are configured for it. They're literally built to process it. They can't just switch to light oil from Texas overnight.
Now, there is another bear thesis floating around regarding that heavy oil demand. We have to address it. Geopolitics. Specifically, Venezuela.
Yes, the Venezuela factor. The argument goes like this. U.S. sanctions on Venezuela ease up. Venezuelan heavy crude, which is very similar to Canadian heavy, floods the U.S. Gulf Coast market.
Okay.
And the U.S. refineries, which are built to process that heavy sour crude, start buying Venezuelan barrels because it's closer by ship than Canadian oil is by pipe.
And the result is Canadian barrels get pushed out and Enbridge loses volume on the long haul down to the Gulf.
Yeah.
That's the fear.
That is the fear. Did management address this?
They did. And they were quite dismissive of the risk. Their rebuttal had a few layers.
Okay, what were they?
First, Venezuelan production is a mess. It is going to be very, very slow to ramp up. You can't just flip a switch after years of underinvestment and corruption. The fields are degraded.
Right. The infrastructure there is rusted out. It takes billions of dollars and years of time just to fix what's broken.
Exactly. Second, the Gulf Coast refineries have a massive appetite. They are the most complex refineries in the world. They can take both. It's not an either-or situation.
Yeah.
There is enough room for everyone. And they had a specific logic about how it might actually help Enbridge. Right. This was the really interesting part of the geopolitical puzzle.
This was the heads I win, tails you don't lose argument. It was very clever.
Walk us through it.
They said, look, let's say Venezuelan heavy barrels do hit the Gulf. Okay. They displace something. But they likely displace light barrels from the Permian Basin that were being blended or used in domestic refining.
So the light sweet crude from Texas.
Right. If those light barrels aren't needed in the Gulf anymore, they need to go somewhere.
They need to be exported.
Exactly. They get exported to Europe or Asia. And how do they get to the water? How do they get on a ship? Through Enbridge's Ingleside export terminal.
Ah, so if Canadian heavy flows south, Enbridge gets paid on the main line. If Permian light needs to leave, because Venezuelan heavy came in, Enbridge gets paid at the Ingleside terminal.
That is the beauty of the network. They have hedged themselves physically. They win in almost every scenario.
Okay, so the main line is full. They need more capacity, but you can't just build a new pipeline these days. It's politically toxic. It takes a decade. We all saw what happened with Keystone XL.
A nightmare. It got canceled after billions were spent.
So what are they doing instead?
This brings us to mainline optimization, or MLO. They have MLO1, MLO2, and a potential MLO3.
MLO. Sounds like a military operation.
It's a capital efficiency operation. MLO1 is already sanctioned. It's happening. It adds 150,000 barrels per day of egress.
That's a decent-sized pipeline on its own.
It is. The cost is about $1.4 billion. Then there's MLO2, which they're commercializing now for a 2028 in-service date. That adds another 250,000 barrels per day.
And how are they doing this without laying hundreds of miles of new pipe and triggering massive protests?
Physics and chemistry. They are using drag-reducing agents. These are chemicals that make the oil flow smoother, reducing friction inside the pipe. They are upgrading pump stations to push harder and more efficiently. They're optimizing storage tanks. These are all brownfield expansions.
Meaning they're just tweaking the assets they already own.
Exactly. You don't need a presidential permit to upgrade a pump station in the middle of nowhere. It avoids the regulatory hell of a greenfield project. It's faster, it's cheaper, and the returns are much higher.
And then there is MLO3. They called it the nuclear option.
MLO3 is the concept for the future if production keeps growing. It's their way of signaling to producers, we have more room to grow if you need it. It tells the market that Enbridge isn't growth constrained on the liquid side, they're just being disciplined.
Got it. So liquids is the cash cow that just keeps on giving. But let's shift gears to what they call the hidden growth engine, gas transmission.
Yeah.
We talked about data centers, but there's a broader story here about infrastructure shortages across the continent.
North America is short on energy infrastructure, period. We're seeing it everywhere. And management highlighted the Northeast specifically.
New England. I used to live there. Every single winter, energy prices spike because they physically cannot get enough natural gas into the region to heat homes and power the grid.
It's a classic bottleneck. New England is energy starved. And the Algonquin pipeline, which is the main artery that feeds that region, saw 9 of its top 25 all-time volume days just this past winter.
That is incredible. So they're running at max capacity, charging premium rates, basically because no one else is allowed to build a pipe into Boston.
Right, and Enbridge is the one delivering that gas. But the growth isn't just in the cold Northeast, it's in the hot South, the Permian and the Gulf Coast.
LNG exports.
LNG exports. They acquired 10% of the Matterhorn Express pipeline. They sanctioned the Bayrunner and Rio Bravo projects to supply the Rio Grande LNG export facility.
So they're connecting the supply to the LNG terminals, the demand.
Precisely. The total capacity they're adding there is up to 5.3 BCF per day.
Right.
And then there's the Tiger Express pipeline.
What's the story there?
They upsized it. It was planned for 2.5 BCF a day, but the demand from customers was so strong they bumped it up to 3.7 BCF a day before they even built it.
It seems like every time they look at a pipe, customers are asking for more capacity. Upsized seems to be the word of the day.
That is the theme. The world wants U.S. gas, and the U.S. needs pipes to get it to the water. Enbridge is building those pipes.
One area that I think gets overlooked is storage. Gas storage. It sounds boring. You put gas in a hole in the ground, usually a salt cavern, and you wait.
It does sound boring.
But the economics are changing, aren't they?
Storage is becoming incredibly valuable because of volatility. When prices swing wildly due to weather, or renewables dropping off the grid, storage is the buffer. If you own the storage, you can arbitrage those price swings.
So you buy gas when it's cheap in the spring, you inject it into the cabin, and you sell it when prices spike in the winter or during a summer heat wave.
That's the game. And they mention Aitken Creek in BC, and their Gulf Coast storage assets are seeing longer contract durations and higher rates. Storage is being repriced upward. In a volatile world, stability commands a premium.
Okay, so we have growth in liquids, growth in gas transmission, growth in renewables through the AI angle. How does this all translate to the bottom line? Let's look at the financial architecture, the investor context.
Right. This is where the rubber meets the road. It's all about capital allocation. Enbridge has an investment capacity of about 10 to 11 billion Canadian dollars annually.
And that's how much they can spend on new projects without, wrecking the balance sheet or issuing a ton of new shares.
Correct. And they have a secured backlog of $39 billion in projects.
That is a massive backlog. That's nearly 4 years of work, fully booked and ready to go.
It gives them incredible visibility. They know where the growth is coming from for the next 3 to 4 years, and $8 billion of that is going into service in 2026 alone.
So that's cash flow that starts hitting the books this year.
This year, yes.
And what kind of returns are they getting? This is important. If they are borrowing money at 6% and investing it at 7%, they aren't creating a lot of value.
No, the spread is everything, and their new organic projects are averaging around 11% returns.
11%. In a utility and midstream world, that is very, very healthy.
It is high. If you can borrow at 5 or 6% and invest at 11%, you are creating massive shareholder value, and they are doing this while keeping their leverage in check. Their debt to EBITDA is at 4.8x.
Which is safely within their target range of 4.5x to 5.0x. But 4.8x is still pretty high for a normal company. Why does the market let them get away with almost 5 times leverage?
Because of the contract quality. 98% of their cash flow is either contracted or regulated. It's highly predictable. Lenders treat them like a mortgage payer with a government job.
The income isn't going anywhere.
It's not going anywhere, so they can carry a bigger mortgage.
Now, there was a question in the Q&A about their growth algorithm. They target 5% annual growth after 2026. And some of the analysts on the call seem to think that was sandbagging.
I think it is sandbagging. Given the data center boom we just talked about, given the LNG export boom, 5% feels like the floor, not the ceiling.
And management sort of hinted at that, didn't they?
They did. They're conservatives by nature. They would rather promise 5% and deliver 7 than the other way around. It's the under-promise, over-deliver playbook.
We also have to mention the utility transformation. They bought those big gas utilities in Ohio, Utah, and North Carolina. That was a controversial move at the time.
It was. That was the big news of 2023, 2024. People were skeptical. They thought, why are you buying low-growth, boring gas utilities? But now we see why.
Why?
The rate-based growth in those utilities has moved from an expectation of around 8% to now around 10%.
What's driving that?
Same story. Data centers, population growth. You need more gas lines to new homes and businesses. Those utilities provide the boring defensive floor to the stock. It reduces the overall risk profile of the company. It makes Enbridge a utility plus story.
So you get the safety from the utilities.
And you get the growth upside from the liquids business and the data centers.
It's a compelling package. You get the yield, you get the safety, and now you get this AI kicker on top.
And that is why the stock reacted the way it did. It's a re-rating event. The market is realizing this isn't just an oil pipe anymore. It's an energy infrastructure conglomerate.
Okay, we have covered the numbers, the strategy, the pipes. Now it is time for the segment everyone waits for. The part where we take off the responsible investor hat, the one that cares about dividends and safety, and we put on the hedge fund cowboy hat.
The "this is not financial advice" segment, my favorite part of the show.
Exactly. And the disclaimer is critical. This is for entertainment purposes only. Please do not actually do this. We are just brainstorming wild ideas based on the data. So what is the trade?
I call this trade the brownfield barren arbitrage.
The brownfield barren arbitrage. I like the sound of it. It sounds aristocratic and ruthless. Lay out this setup.
The setup is this. The market is obsessed with AI chips, NVIDIA, AMD, all of that. We all know that trade. But everyone is now realizing the bottleneck is power and cooling.
Right.
Building new power plants is hard. But building new transmission lines, the wires to move the power, is even harder. It takes 10 years, maybe more, to permit a greenfield transmission line in the U.S.
It's a nightmare. NMBism, not in my backyard. Environmental reviews, lawsuits. It's almost impossible to build anything new from scratch.
Exactly. But Enbridge already has the right-of-way. They have the existing pipes. They have the land. They have the relationships. They are the incumbent.
So what's the trade?
The trade is long Enbridge, ticker ENB, and you go short the pure play green developers or constrained utilities who are trying to build from scratch.
Okay, walk me through the legs of the trade. Leg 1, long Enbridge.
You go long ENB because they're effectively laundering electrons.
Laundering electrons, that's illegal.
It's perfectly legal. Hear me out. They take dirty natural gas, move it to a power plant right next to a data center, or they build solar on their existing land, on their brownfield sites, and they sell that power directly to Meta or Amazon.
So because they're doing it on existing brownfield sites, expanding what they already own, like with MLO 1, 2, and 3, they avoid that regulatory hell.
They skip the line. They are the brownfield baron. They can bring new power to market in 2 years, not 10. And the hyperscalers Meta, Google will pay a premium for that speed.
They will pay any price. If you are Meta and you need to beat Google in the AI race, you are not going to wait 7 years for a permit. You are going to call Enbridge and say, what can you give me right now?
Speed is the only currency that matters in the AI arms race. Enbridge becomes the bouncer at the door of the power grid. If you want in, you pay the baron.
Okay, that's the long leg. And leg 2, the short.
You short the companies trying to build new transmission lines, the greenfield dreamers, or the developers who are relying solely on government tax credits that might vanish under a new administration.
So you're betting against the guys stuck in purgatory.
You're betting against the lawyers and the lobbyists. Those companies will get bogged down in permitting for a decade. Their capital will be trapped. They will burn cash on legal fees while Enbridge is cashing checks from Facebook.
It's a ruthless thesis. The old guard wins because they already own the dirt.
It's the shadow utility theory. Enbridge effectively becomes a private shadow utility for the Mag 7, completely bypassing the traditional slow-moving grid. The grid is too slow. Enbridge is fast.
That is outrageous
Oh,
and strangely plausible.
yeah.
It highlights the value of incumbency. In a world where you can't build anything new, the person who already built something is king.
That's the best kind of trade. One based on regulatory failure and the laws of physics.
Indeed. Again, do not do this at home. But it is a fascinating way to think about the competitive advantage of incumbency.
It is.
All right, let's wrap this up. We have covered a lot of ground today.
We certainly have.
Let's do a quick recap for everyone listening. Enbridge delivered a solid beat and raise. The stock reacted violently upwards, up nearly 4% on massive volume. The market is buying the new narrative.
And the key takeaways are clear. The main line is full and it's generating a ton of cash. Data centers need massive amounts of reliable power, and Enbridge is the one to deliver it. And that dividend is safe, it's growing, and it's supported by an incredibly diverse asset base.
It's a utility that's starting to act like a growth stock, or at least the market is starting to see it that way. It's shedding its boring skin.
Yeah, it's definitely waking up.
We will leave it there. Please check the show notes for the ticker symbol and the links to the earnings deck if you want to verify all these numbers for yourself.
And keep an eye on those volume numbers. The institutions are awake on this one.
Indeed they are. This has been Talk Tickers. We'll see you on the next deep dive.